If you had invested just $100 a month into the stock market over the last 20 years, you could have turned it into more than $60,000 today. But most people never start because they think investing is complicated, risky, or something only the wealthy do. The truth is, building your first investment portfolio is simpler than you think. And today, I'm going to walk you through it step by step. Welcome back to the channel, where we break down money, investing, and financial freedom in simple terms. First, let's answer the obvious question: why invest at all? Saving alone isn't enough. Inflation eats away at the value of your money every year. If inflation is 3% and your bank savings account pays you 1%, you're actually losing 2% of your wealth in real terms. Investing is how you grow your money faster than inflation. Over the long term, the stock market has returned an average of 7 to 10% a year. That's why your future self will thank you for investing today. Even small amounts can snowball into life-changing sums thanks to compound growth. Before you invest a single pound, you need to be clear about your goals. Are you investing for retirement, a house deposit in 10 years, or simply to build long-term wealth? Your time horizon and goals determine your strategy. For example, if you need the money in 2 to 3 years, investing in risky assets like stocks isn't a good idea. You'd want safer, more stable investments like bonds or cash savings. But if your horizon is 10, 20, or 30 years, you can afford to ride out market ups and downs. The easiest way to diversify? Index funds and ETFs. The S&P 500 ETF gives you exposure to the 500 largest U.S. companies like Apple, Microsoft, and Amazon. A global stock market index fund spreads your money across thousands of companies worldwide. That way, you're not betting on one winner. You're owning a piece of the whole market. Let's talk about what your beginner portfolio could actually look like. A simple but powerful strategy is called the core and satellite approach. Core: 80–90% of your money goes into broad, diversified index funds or ETFs. Satellite: 10–20% can go into things you're curious about, like individual stocks, real estate investment trusts, or even sectors like technology or clean energy. A couple of well-chosen funds can already give you a solid, diversified portfolio. To begin your investing journey, decide how much to invest, aiming for 10–20% of your monthly income without impacting essential expenses. Even starting with just $50 or $100 each month can be impactful, thanks to the power of compounding. Remember, the best time to start investing was yesterday. The second best time is today. Now let's automate your investment strategy with dollar cost averaging. This strategy allows you to invest a fixed amount every month, regardless of market fluctuations. This method smooths out the highs and lows of investing while relieving stress. However, beginners must avoid common traps that can derail their investments. Chasing hot tips and overtrading can lead to unnecessary losses. It's crucial to resist the urge to panic sell during market downturns. And never forget to keep an emergency fund before investing. Finally, the most vital aspect of investing is patience. Investing $200 each month could grow to over $250,000 over 30 years at a 7% return if you stay the course. Recap the steps: define your goals, understand risk, diversify, set your investment amount, automate, avoid beginner mistakes, and stay consistent. Following these steps will place you ahead of most who never take the first leap. Remember, the greatest investment is in your financial education.